Is the economy dipping into a recession in real time? Massive results. And from yesterday's record setting 10-year Treasury auction, huge inflation data dropped today, indicating the current state of inflation in the US economy, and initial jobless claims soar. Is the labor market shattering in real time? So, first, we're going to go chronological. Here is the 10-year US Treasury auction from yesterday. Just to run through this real quick. It was notable. So we had a stop through. This is again where the price is actually higher than the starting price or the when issued, indicating very, very strong demand. A stop through is the opposite of a tail where the price must go down to clear the entire supply, in this case, 100 units of XYZ. Remember that as you go down in price, you go up in yield. So a tail indicates the price had to go down to unlock enough demand to clear the entire, in this case, $39 billion. The opposite is also true. If there's so much demand that there are bids above the starting price, or put another way, the yield would be below the starting price, that is known as a stop through. We'll take a look at some graphs that show some of these metrics. Bid to cover is the other main one. This is the total amount of bids divided by how much is trying to be sold. A higher bid to cover indicates more demand relative to something like this, where bid to cover is 1.0. Anything below 1.0 is considered a failed auction. When you hear people say that term, it is indicated by bid to cover below 1.0. Now, bid to cover, we stopped through 1.3 basis points. That is strong. We also had a strong bid to cover, 2.65. The 6-month average is 2.55, so above the 6-month average for the bid to cover, and a stop through. Now, not only that, but primary dealers took down the lowest percentage of the auction on record. And indirect, which is by the way, primary dealers, you can think of that as the buyer of last resort. They're very large financial firms that have a special agreement with the government, and they're expected to come in and buy any bonds that the indirects and the directs don't want. Direct, that is firms like a hedge fund bidding directly for their own firm, for their own portfolio. Indirect, this is a proxy for foreign demand. So primary dealers had to, the buyer of last resort had to take down the lowest amount on record, 4.2% of the 39 billion, and indirect or foreign demand, this was the second highest on record. So again, here you can pause this if you're interested in a bit of a analogy to show how a bond auction works. Here is the indirect graphed out, and we can see this chart goes back to 2004. We can see it is the second highest indirect or foreign demand on record, at least going back to 2004. Here are a number of metrics, including the composition of the buyers, which matters just as much, arguably, as the bid to cover or the stop through or the tail. We can see the bid to cover has been trending up, generally speaking. And again, primary dealers indicated in blue bars here had to take down the lowest amount on record, and the indirect bidders are the second highest on record. So that foreign demand is the second highest on record. And here's a representation of the tail or the stop through. And again, we can see that the past 9 months or so, we have had pretty strong 10-year auctions with only one tail really going back to, say, January, February of this year. So again, bonds are getting bid. They continue to get bid. We are getting a bit of a bull flattener the past week or maybe week and a half. The fact that it's been going on this long, I think, is notable. You don't generally want to look at the shape of the yield curve on a day-to-day basis, but the fact that this flattening has been going on for a while makes it worth a mention. And again, bonds are getting bid all across the curve. Remember that the yield on the bond is inverse to the value of the bond. So as bonds are being bid up, the underlying bond, the yield is actually going down. So we can see 30-year, 10-year, everything is getting bid all across the curve. Rate cut expectations are shooting to the moon. Now I think there's 4 rate cuts being expected over the next 4 or 5 meetings. And again, we can see, for example, that the 3-month is down at 402 while Fed funds is at 433. And so that kind of indicates to you that there is a lot of confidence by the bond market that there will be at least a 25 basis point cut at the September meeting for the FOMC. And again, the distance has been decreasing, the gap between the 30-year and the 2-year. That is what a flattening yield curve represents. And generally, you see a bull flattener ahead of a growth scare. And this is why. So here is initial jobless claims, which we also got this morning. This is arguably the most important data maybe of the week. So initial jobless claims, just what they sound like, the number of people filing for unemployment for the first time. Expectation was 235K. We came in way above that, 263K. Continuing claims were actually lower than the estimate, ever so slightly, but initial claims are breaking out. So, this is not a tradable instrument, of course, but in trading terms, that would be called a breakout. It has come up and touched this kind of 259,000 initial claims level before a couple times, but generally reversed. Well, we broke clean through that. And I think, there in red is the 9-week average, moving average, because again, as you can probably see from initial jobless claims, there's a lot of, week to week sort of noise or volatility. However, the 9-week moving average has been moving up. It is still nowhere near the levels here set in August of last year or in July of 2023. Again, this is going to lag. The moving average is going to lag, kind of by definition, but it can help you to sift through some of the kind of week to week volatility, as you can see, is pretty common with initial claims. But this is the highest initial claims rating going all the way back to October of 2021. So here are the unemployment rates. And, when it comes to the labor market is okay until it's not okay. And when it's not okay, it gets really not okay very quickly. As we can see back here in 2008, initial claims started to kind of curl up, and then all of a sudden they just went vertical. So there is a degree of non-linearity that goes on with the labor market during a recession. I will add recession so that you can see the unemployment rate relative to those recessions. You can see it kind of goes non-linear during a recession. Here, the headline unemployment rate is very, very low, going all the way back to the 70s. U3, which is what headline unemployment is, this is a relatively narrow way to measure unemployment. It is very low, historically speaking. However, if you look at youth unemployment or U6 unemployment, which includes discouraged workers, marginally attached to the labor force, part-time for economic reasons, arguably a much more accurate version, a way to measure unemployment or the state of the labor market, that is running double the rate of the headline unemployment rate. Now, youth unemployment is even higher. So while U3 is basically very close to all-time lows, that headline unemployment, youth unemployment, on the other hand, is indicating more weakness than we have seen. This chart goes back to the 80s, and again, U6 is the same story. So while U3 paints a very rosy picture, very narrow way to think of unemployment, U6 and youth unemployment paint a different picture. Now, college graduates have the same unemployment rate as non-college graduates. This is very rare. And again, one of those kind of signposts of weakness in the labor market. Generally speaking, when the labor market does start to weaken, you see things like youth unemployment or black unemployment. Those start to go up first, and are generally a harbinger of the headline unemployment reading to follow. So there's certainly weakness starting to be seen in the labor market, as we can see from, for example, U6 and youth unemployment certainly moving in an upward direction. Again, this bottomed back in 2022. Unemployment has been heading higher for 3 years. And the same is true with initial jobless claims, by the way. That bottomed back in 2022, mid to late 2022, and has been moving higher ever since. So labor market has been weakening. There's no doubt that the labor market has been weakening. Now, we also got consumer price index. This is the main inflation gauge that most people are probably familiar with. Here we can see the expectation for the monthly figure. The estimate was 0.3%. Well, we came in slightly above that at 0.4%. If you look on a year over year basis, The expectation came in right in line with the actual reading of 2.9%. Core, which excludes food and energy, which can cause, which are inherently very volatile. And so core seeks to remove the volatile components to get an idea of what's really going on underneath the surface. Core came in zero point 0.3 month over month, just in line with expectation. And on a year over year basis, came in 3.1%, which was last month's reading as well for core inflation. Now, it's important to point out inflation. Here we have also core PCE, which is the Fed's preferred gauge. It's just a slightly different way to measure inflation. They like PCE. While PCE is running at 2.9%, core CPI is running at 3.1, and headline CPI is going up. So again, while it was in line with expectation, as you can see, it bottomed here back in April at 2.28, and it has been heading higher. So I said April, bottomed in April. Many people are probably thinking, oh, well, it's the tariffs. This shows that is not really the tariff. So this shows the composition of what is driving CPI. Now, remember, energy is included in the headline CPI figure that we're looking at here. That is denoted by a blue bar, light kind of baby blue bar. Well, you can see that has been causing been in deflation or helping to disinflate, bring that rate of inflation down. Well, it's starting to reverse that. And if you look at goods relative to services, services are denoted in this kind of dark blue color, and core goods are denoted in this green color. You can see that goods is making up very little, only about 30 basis points of the 3.1 or 310 basis points. Of the 310 basis points of inflation, goods are only making up 30 basis points. Services is really the story. That is really what is driving inflation. That is really what is sticky. That is 217 basis points in terms of services. So here we're looking at core removing, again, food and energy and components that are volatile. And it's the same story. You can see this hopefully is easier to make out the difference between goods and services. Services are in blue, and core goods are in a yellowish color. And you can see that core goods are only, again, about 30 basis points of that 3.1%. Only about 30 basis points is being made up by goods inflation. The vast majority of inflation right now is coming from the services side. Now, here is the report. I will link to it in the description. There were a couple notable things that I'll point out here if I can get the chart resized. So the 12-month average, unadjusted 12-month average, ending in August, we can see here that if you look at the price, the rate of change of the price of gas service, right? So your heating bill, that is up 13.8%. If you look at the other energy commodities, those have been again in a deflation, or the price has been falling and helping to get that rate of change to decline for the headline index. Remember, headline CPI includes food and energy. So it has been helping out the headline index, the headline CPI reading, that in energy and commodities kind of writ large have been falling in price. However, what we see here is that utility or piped gas service up 13.8%. This is certainly going to cause the headline reading. Again, core does not include energy, but the headline reading, if natural gas and oil start to really bounce here in terms of price, you could see the headline CPI reading, which is 2.9%, basically 3%. And remember, the only thing kind of keeping it down or helping it to come down has been really energy. So once you see energy start to move, like it might be doing, the month over month reading was 1.6%, but this is the unadjusted 12-month rate of change, 13.8%. If you look at gasoline, was another large driver of this particular print, 1.9% month over month a rate of change. Now, again, gasoline prices are volatile. However, it should be pointed out again, energy has been what has been helping to keep a lid on that headline CPI figure. So if you start to see oil, natural gas, energy commodities start to move higher, that could really get inflation to pick up. Again, it's already at 2.9, which is about 50% higher than the Fed's long run average of 2%. So I will link this report. That is probably the most important, at least with inflation. I would say it's very, very important to continue to watch the price of oil and the price of natural gas. So here I want to give a quick update on the dollar liquidity squeeze that we have been talking about. This is still really not correcting. So it has corrected a bit. I think we set a peak of 9 basis point spread. It has come down marginally down to just 6 basis points. But again, it is basically right at IORB. And generally, that is not how it works. And again, I don't have the lines on this chart. I should have saved it. But all of these other SOFR spikes above Fed funds up to IORB, maybe, all of those coincide with either month end or quarter end periods of time when there's window dressing, when the banks are, trying to make everything look nice to the regulators and to their investors. Maybe this is not quarter end or month end. So this is the only time that we have seen SOFR Fed funds over 5 basis point spread in like 4 or 5 years, where it was not month end or quarter end with the window dressing. So here is how markets, generally speaking, are taking the initial jobless claims data as well as the inflation data. We can see gold still quite strong. It really cannot pull back. It tried to pull back earlier today, just cannot pull back. You look at Bitcoin, that is catching a bid though. However, it's got a lot of territory to make up to catch up with gold. The S&P 500 is up significantly, about 0.8%, along with the NASDAQ. VIX is down on the day, but at least in my opinion, it looks like it is wanting to move higher, have another one of these spikes higher. 14 is probably a good time to hedge, not financial advice, just my personal opinion. It appears VIX does not really want to go below like 14.5. If you look again at the 2, 10, and 30-year yields, they are all getting bid. However, the 2-year yield is starting, people started to sell the 2-year at 347. And we can see that denoted by the bounce here. That is not as pronounced at the long end of the yield curve, say in the 30-year or even the 10-year. The dollar is down again. The dollar really cannot catch a bid. And when it does, it gets sold into pretty immediately. So again, labor market, there are certainly some concerning signs here. My base case has not been for a recession. I've been giving it kind of a 30 to 40% odds. I would say with this initial claims number, again, it's just 1 week of a data point. But if this continues with like another initial claims up at these levels, then I would probably give that recession a probability much more of like a 50 to 55, maybe even 60%. You don't want to see the labor market weakening because when it weakens quite rapidly. And again, generally you see that with youth or Black African American unemployment. Generally, those sorts of sectors or groups, generally they see weakness in unemployment or in the labor market before the headline and kind of overall labor market does. So the fact that youth unemployment has been heading sharply higher is probably a warning sign. Now, I've been saying there's a large degree of normalization going on. And I think that piece of context is still very true and very worth pointing out from the 2020 through 2024 distortions, both on the kind of immigration side, but also on the economic side. I mean, it takes years for monetary policy decisions and monetary stimulus to work its way, and subsequent QT to work its way through the system. So we really are feeling some of the effects of monetary policy maybe 2 or 3 years ago. So there's a large amount of normalization. We can see just how volatile 2020 was for the norm. You can see that really again with youth unemployment went up to 29%. But this, is going to take some time to normalize, especially when you add in the immigration policy of both the last administration and then this administration, kind of reversing some of those things. That'll take a while to work its way through. And of course, with increased bets for Fed rate cuts and weakness in the labor market, bonds are getting bid. This 10-year note auction cannot be ignored for its strength, both the stop through, the bid to cover, and primary dealer and indirect composition of the bidder. So hopefully that was helpful, and I will catch you on the next one.